Ladies and gentlemen, good morning and welcome to the SJS Enterprises Q4 FY23 conference call hosted by Axis Capital Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Rakesh Jain from Axis Capital Limited. Please go ahead.
Thanks, Anne. Good morning, everybody. Welcome to the Q4 FY23 conference call of SJS Enterprise on behalf of Axis Capital. We will initially begin with the opening remarks from the management. On the management side, we have Mr. K.A. Joseph, Managing Director and Co-founder, Mr. Sanjay Thapar, CEO and Executive Director, Mr. Mahendra Naredi, Chief Financial Officer, and Ms. Devanshi Dhruva, Head Investor Relations. I would now request management to proceed with their opening remarks and then followed by Q&A. So would request Devanshi, please, if you can start the call.
Thank you, Rakesh. Good morning, ladies and gentlemen, and thanks for being with us over the call today. We appreciate it. Moving on, this is how we intend to take today's conference call forward. I will pass on the dial to Mr. K.A. Joseph, our MD, who will make the opening remarks and brief you all about our latest acquisition of Voltapack India. Then he will hand it over to Mr. Sanjay Thapar, our CEO and Executive Director, who will take you all through some of the slides of our presentation that has been uploaded on the stock exchange as well as on our website. Sanjay will take you all through the industry view, our business performance, and give the strategic outlook for the future growth of the company at the end. And Mr. Mahendra Naredi, our CFO, will update you on our financial highlights, post which we will open it up for Q&A. The duration of this call is around 60 minutes, and we will try to wrap up our comments in about 20 minutes so that we leave enough time for you guys to ask questions. If the time is not enough, please feel free to reach out to us through email, and I will try to answer all your questions to the best of my abilities. Thank you once again, and I will now hand it over to Mr. Joseph to make his opening comments. Over to you, Joe.
Yeah, thank you, Devanshi, and hello and good morning, everyone. I hope you have had a chance to look at our investor presentation and results published yesterday. While Sanjay and Mahendra will take you through the presentation later, let me start by sharing my perspectives on the synergistic acquisition of Voltapack India. As we had shared earlier, inorganic growth is one of the core strategies, and we believe the same will help us in reinforcing our market leadership in the decorative aesthetic business. Exotec Plastics, manufacturing of chrome-plated and painted plastic parts, was our first acquisition in April of 2021. Within 2 years of the acquisition, we have been able to successfully integrate the business, which has resulted in doubling of revenues at Exotec, coupled with improvement in EBITDA margins. After the successful acquisition of Exotec, we have become more confident of acquiring and integrating companies that could take SJS to the next level of growth. Voltapack India is a subsidiary of Voltapack Spain, was founded in 2006 and is headquartered in Pune. It's a leader in design and development of high value-added functional decorative parts in India. Our primary driver of interest in Voltapack is its complementary and adjacent technologies of IMF, IMD, and IME. IMF is Voltapack's core business. This technique is used to produce high-quality three-dimensional plastic parts with decorative finishes, which are robust and resilient to abrasion and wear. This technology is complementary to the IML technology that we have at SJS. IME technology allows us to integrate electronic functionality and even hybridization of electronic components in films. All these are emerging technologies in India with high growth potential and high margin for the future. We have also signed a 3-year service and technology support agreement with Voltapack Spain for ongoing exchange of know-how. It will help us in sharing technical know-how, provide us access to new technology upgrades, and will ensure Voltapack customers of technology and quality support in a seamless manner. Another important driver for this acquisition is cross-selling opportunities. thereby providing strong potential to both acquire new customers as well as increase the share of wallet with existing customers. This acquisition will also help us in diversifying the end industry revenue split, as Walterpac caters primarily to passenger vehicles and consumer electrical segments. An important aspect of this acquisition is that the Indian promoter and head of Walterpac India, Mr. Roy Matthew, will continue to retain a 9.9% equity stake in the business, and that will ensure smooth integration from day one. Talking of numbers, Walterpac had an interim revenue of rupees 1,200 million and healthy EBITDA margins of around 30% with an attractive ROCE of over 50% for FY23. We are acquiring Walterpac India via bilateral engagement at a reasonable valuation of approximately 7 times FY23 EBITDA, and will pay a total cash consideration of rupees 2,393 million for 91.1% stake. The transaction is funded primarily by internal accruals with some debt and a preferential investment of rupees 300 million by me. We expect Walterpac acquisition to be EPS accretive in current year itself. Walterpac would also add scale to SJS, given Walterpac's EBITDA is approximately one-third of SJS EBITDA. We are looking forward to close this acquisition in the coming 3 to 4 weeks. Along with Walterpac acquisition, we are looking to grow SJS consolidated revenue in FY24 by over 50%. The EBITDA and PAT should grow by a bit lower, by around 40%, as we balance higher growth with margins. I would now like to hand over to Sanjay to take you through some of the business and industry highlights for the quarter and the year. Thank you, and over to you, Sanjay.
Yeah, thank you, Joe, for updating investors on our acquisition. Hello and good morning, everyone. You referred to the presentation that has been uploaded, so I start from slide 4. As you all know by now, SJS is India's leading and globally recognized decorative aesthetic player with an end-to-end design-to-delivery capability. We operate in the high value-added decorative aesthetics market across multiple consumer-oriented industries. Talking of Q4 and this financial year gone by, we remain confident of our ability to benefit from premiumization trends in the industry and deliver new technology products to customers across end segments over the medium and long term. Specifically for highlights for this quarter, SJS with a YOY revenue growth of 3.6% in the automotive segment continues to grow ahead of the automotive industry, which witnessed almost a flat growth, both two-wheeler and four-wheeler volumes combined. Revenues at 1,065.7 million grew by 2.4% on the back of a 17.2% growth in our PV business. This growth was largely offset by a lower demand in the two-wheeler and the consumer sector. Consistent delivery of robust margins has led to strong cash flow generation of 609.5 million for the year for the company, and our cash and cash equivalents at the end of this quarter stand at 1,648.2 million, which we will utilize for funding the Walterpac acquisition. We are also happy to inform you that during the quarter we've added Litmed as a new customer in the medical devices segment and also entered the EV segment with Samsung in India. On the CSR front, the company supported education and health initiatives for over 1,200 children across 10 plus government schools. So during this quarter, SJS has grown ahead of the industry despite various external challenges like regulatory headwinds in the domestic two-wheeler segment, impact on exports due to the prolonged geopolitical issues, and the macroeconomic headwinds like inflation, rising crude prices impacting demand recovery in consumer appliances. Just to update you, the government announced implementation of stricter environmental OBD2 norms with effect from 1st of April 23. As a result, in Q4, the two-wheeler industry production volumes were impacted as OEMs wanted to correct the inventory of non-compliant two-wheelers. In Q4, therefore, the two-wheeler industry degrew by 3% YOY, and SJS two-wheeler sales declined by about 6.3% YOY due to the implementation of this regulation. However, as we mentioned earlier, there's a large two-wheeler OEM that we do not supply to amongst our two-wheeler customers, and we exclude their OEM's numbers. The rest of the two-wheeler industry production volume degrew by 9% YOY for this quarter. Against this, SJS was at 6.3%. The company's passenger vehicle growth at 17.2% YOY exceeded the industry production volumes of 13%. Overall, our automotive two-wheeler and four-wheeler business grew by 3.6% YOY compared to a flat industry performance. Overall, the consolidated revenue for SJS grew at 2.4% YOY. That was for the quarter. Coming to the full year, for FY23, we delivered a strong performance. SJS with a 23.1% YOY growth in the two-wheeler segment exceeded the two-wheeler industry production volumes of 9.2% YOY growth. Passenger vehicle industry volumes grew by about 25.4%, while SJS passenger vehicle revenue was higher at 27.8%. So we've grown well within our set of PV customers. Though our PV journey is still in nascent stages, but we are very new businesses and we will continue this growth momentum moving forward. The trajectory for growth in the PV segment looks very promising, especially post the Waterpack acquisition. That is proficient and advanced in IMD, IMF, and IME technologies. And it earns 2/3 of its revenue through the passenger vehicle segment. Overall, FY23 automotive performance, two-wheeler plus four-wheeler grew at 11.9% YOY, while SJS had a robust growth of 25.1% on a consolidated basis. So we witnessed an 18.3% YOY growth. This was achieved despite all challenges that I mentioned above. Our diversification strategy of various product categories present across multiple industry segments and a vast customer base has consistently helped us during a year to minimize the impact of industry slowdown in specific segments. I now over to slide 8. We would like to share some business highlights with you that will help us achieve our medium-term goals. We consistently focus on building mega customer accounts. We continue to expand our share of wallet with key customers by offering new products and winning new businesses. This quarter, we won many new businesses with our customers like Mahindra, Maruti Suzuki, TVS, Royal Enfield, Honda, Uno Minda, Atomberg, and Godrej, among others. This quarter, we also added new customers like LitMed in medical devices segment, and won our first order for the Samsung TV segment for supplying a special form of decal. We even won orders from EV OEMs like Alti Green and Hop. Coming to slide 9, for the third time in a row, your company has been certified as a great place to work amongst mid-sized organizations in February 23. We are grateful to all our stakeholders, including our employees, who have been instrumental in making SJS a great place to work. The next two slides, 10 and 11, talk of our ESG framework and our CSR initiative. As a responsible corporate, SJS is committed to the health, safety, and environmental concerns while balancing a sustainable growth objective. In line with this objective, SJS has defined a ESG framework that will support SJS growth in the right direction and a sustainable manner. If anyone would like to understand further details of our ESG initiatives, please reach out to Devanshi, who heads Investor Relations at SJS. In our commitment to good corporate citizenship, our company is determined to create a positive impact on the society at large with meaningful social welfare activities, especially in the area of education, skill development, healthcare and sanitation, rural development, and environmental protection, which are key focus areas for SJS. We believe in inclusive growth, not just for employees and stakeholders, but also for the community around us. Last quarter, we took a few initiatives with respect to education and healthcare, distribution of school bags, e-learning kits, furniture to government schools. We also, almost 1,200 children benefited from a free eye checkup camps that we conducted, and distribution of spectacles to close to about 170 children who never even knew that they had an impaired vision. Distribution of computers to police stations, so we do our bit for the society around us. I would now like to hand over the call to Mahendra, our CFO, to update you on this SJS financial performance before I go on to talk about our future growth outlook. Over to you, Mahendra.
Thank you, Mr. Thapar. Good morning, everyone. Moving to the slide 12, which talks about our financial performance in detail. I would like to highlight that during Q4, the company showed resilience in difficult time and maintained revenue at rupees 1,065.7 million, witnessing 2.4% YOY growth. A strong growth in PV segment of 17.2% was largely offset by 6.3% decline in two-wheeler segment and 2.9% decline in the consumer segment. EBITDA at rupees 271.8 million grew by 1.8% YOY on a margin of 24.8%. 57 basis impact due to product mix change in favor of exotic and lower export sales. PAT at rupees 153.9 million was flattish on YOY basis. Margins at 14.4% was impacted 32 basis on account of lower EBITDA. Moving to the next slide. For full year basis, we are consistently delivering a robust performance. SJS clocked 18.3% YOY revenue to rupees 4,330.5 million, boosted by 24.2% YOY growth in domestic sales. EBITDA grew 23.2% on YOY basis to rupees 1,167.8 million, with a margin of 26.4% and improvement of 75 basis. PAT grew 28.8% YOY to rupees 672.5 million on a margin of 15.5%, 127 basis expansion despite lower export sales and challenging environment. I am happy to share that all our efforts and initiatives taken post exotic acquisitions are adding growth and momentum to the consolidated business. We have more than doubled our revenue at exotic just within 2 years of acquisitions. EBITDA margin in financial year 23 improved to 15.2% from 12.2% in FY21, around 300% or 300 basis improvement in 2 years on back of operational efficiencies. Overall, a commendable performance showcased by exotic. Moving to slide 14, both two-wheeler and passenger vehicle share of revenue has increased to 44.8% and 32.5%, while consumer durable witnessed a decline in revenue share to 15.4% due to macroeconomic headwinds, rising inflation that lead to subdued demand in Europe and North American markets. Share of business from export declined due to adverse impact of geopolitical issues and macroeconomic challenges in many regions. Decline in export also impacted sale of new generation products to a certain extent, and hence overall contribution of new generation products to revenue is 9 to 10% for FY23. However, we are confident that despite near-term challenges, our medium-term growth target for the consumer segment and a strong focus on export remain intact. With the acquisition of WPI, we believe that our share of revenue from passenger vehicle and consumer segment will considerably increase. Growth in this business will lead to a higher revenue contribution of new generation products like IMD, IML, and IMF going forward. Next slide gives you our financial highlights in a snapshot in a tabular format, which we have already discussed in the previous slide. Moving on, as on 31st March 2023, SJS has built a comfortable consolidated cash and cash equivalent of around rupees 1,648.2 million, which will be utilized for funding our WPI acquisition and expansion. We are a debt-free company on a net debt basis, and our long-term borrowing rating from ICRA is A+ stable. The company generates strong free cash flow, and for FY23, we have added rupees 609.5 million. Our Free cash flow to EBITDA for FY23 stand at a healthy rate of 52.2%. As on 31st March 23, we have achieved robust ROC of 33.1% and ROE of 15.7%. I would now like to hand over the call back to Mr. Thapar to talk about the plans and growth outlooks.
Thank you, Mahendra. Now, moving to slide 17 to 21. Since Joe has already explained to you about the acquisition, I will not spend too much time on that. However, I'd like to mention a few key points on the slide 20. So with this acquisition, we've not only acquired a very profitable business at a good valuation, but at the same time achieved key strategic objectives. One amongst them was to acquire new technologies. So technology like 2K injection molding, laser decoration, large part, in-mold forming to manufacture three-dimensional IMF parts with complex surface geometries, along with in-house tool design capability for IML, IMD parts, 6-axis milling capability, 3D trimming, etc. All these are new capabilities will supplement the vast array of technologies already available at SJS, and together they will help create a formidable advantage for SJS from a global perspective. The second benefit we have is a technology support agreement that we signed with Walter Pack Spain, who is one of the leaders and global leaders and the go-to benchmark for in-mold forming technology as a part of this deal, which is a big plus. We've also added management bandwidth to the company with Roy Matthew, the man behind Walter Pack India and instrumental for growth of the India business. He will continue with Walter Pack India as a part of this deal. He will continue to hold 9.9% stake in Walter Pack India. This will help in seamless continuity and running of the business for SJS. Roy will report to me and Joe, and as is done by the other business unit heads of SJS. Roy, who is a tooling engineer by qualification, is a seasoned professional. He has been associated in developing IMF technology with Walter Pack Spain for almost 15 years now, and is a subject matter expert. He has expertise in handling business development, design, and operational functions. His tooling expertise fits in perfectly with the SJS team capability like a missing piece in a jigsaw puzzle, and this will complement SJS capabilities. I now move on to our future growth outlook. We have been on the forefront of leveraging technology for developing premium and aesthetically differentiated products that are complex to manufacture and will enable us to increase our addressable market significantly. Our R&D teams bring about consistent breakthroughs in product innovation, enabling us to meet evolving customer needs and stay ahead of the curve. For passenger vehicles, I quote some examples here. Passenger vehicles, we are working on products like optical plastics, cover glass, IMD parts integrated with IME, illuminated logos, among others, and this will increase our kit value of passenger vehicle offering by 3 to 4x from the current 1,200 to 1,500 rupees per vehicle. For two-wheelers, we target to increase the kit value by 2 times from the current 300 to 500 by adding futuristic products like cover glass for two-wheeler instrument cluster with touch functionality and IME molded parts that integrate multiple functions in a molded decorative substrate, especially for the EVs. For consumer appliances, our target is to increase the kit value by about 3 to 4 times from the current 50 to 150 rupee range that we have currently, with the addition of futuristic products like, again, optical glass with HMI functionality for control panels, printed electronics, and capacitive touch functions. There is an immense opportunity for growth, and we are confident of achieving it in the near future. The Walter Pack acquisition will be a force multiplier for SJS, as it opens up another window of opportunity for us through their presence in IMD, IML, and IMF and IME technologies in the PV and the consumer segment. Needless to say, we will create many cross-selling opportunities as well, like we did at Exotech. SJS has a large consumer appliance customer base, and Walter Pack is largely focused on automotive passenger vehicle customers with some consumer electrical business. Its technologies such as large in-mold forming and decoration will help SJS supply large-size IMF panels to washing machines, as for an example. Expertise in 1K and 2K injection molding and IMD will help us to address the medical devices segment faster With this acquisition, SJS will become a significant player in the automotive interior space. Decorative interior trims with panels which are with or without ambient lighting, 2K molding will help us deliver high quality IP trims for the dashboard of passenger vehicles for both IC and EV powertrains. This will add almost 2,000 to 3,000 rupees in terms of content per vehicle. Now quickly moving to slide 26, which talks about our inorganic strategy over the medium term. SJS will continue to deliver on its guidance of robust financial and operational performance. We are very happy to state that despite external challenges, FY23 organic sales growth has been 18.3% for your company, with the best-in-class EBITDA margins at 26.4%. The company achieved a PAT growth of 28.8% during the year, thereby achieving a guidance for the year. We are positive that going ahead as well, SJS will maintain its higher revenue growth margin trajectory. In the near term, there could be some minor challenges as macroeconomic scenario has still not stabilized. It may take a few more months before export also start recovering. However, our medium-term story remains absolutely intact, with 20 to 25% revenue growth over the next 3 years from FY23 to 26. Our strategic growth drivers would be winning new businesses, increasing wallet share with existing customers, adding new customers, penetrating deeper into new geographies, and increasing content by adding exciting new premium products to our portfolio. Hence, we believe SJS will continue to outperform the market. Recovery in the consumer sector and export markets and tailwinds of a resurgent auto industry will add the required fuel to accelerate momentum of our growth trajectory. On the capacity front at Exotech, is at well on track. Currently for FY24, the company has created alternative solutions to maintain the growth trajectory till additional capacity becomes operational. I now come to our inorganic growth strategy. Over the last 2 years, the company has demonstrated its ability to acquire and integrate and grow the Exotech business. As mentioned earlier, we have doubled Exotech revenue post-acquisition in the last 2 years, and EBITDA margins have improved by 300 basis points during the same period. This clearly demonstrates our ability to integrate and grow the acquired businesses successfully and our ability to cross-sell products across new and existing customers rapidly. This gave us the confidence that we are on the right path of growing our business through the inorganic route. We believe every acquisition will be a stepping stone for SJS to achieve higher business growth. This time, high growth, high margin business to our portfolio. We will evaluate other acquisitions for both those as well in future that we believe would add value to SJS and create value for all our stakeholders. And I come to slide 28, highlights for our FY24 outlook. So SJS will continue to outperform the industry despite the continuing macroeconomic headwinds. At the consolidated level, we expect SJS revenue to grow by 50% YOY on account of the expected positive outlook for the two-wheeler, passenger vehicle and consumer segments. So key drivers for this are premiumization plus new customer wins plus exports plus Walter Pack India acquisition will all lead to a higher than industry sales growth for SJS. We have a very high visibility of our current order book, being over 85% for the FY24 forecast revenue. Our margin profile will remain as robust as ever for the current business. Addition of Walter Pack and we expect operating leverage to drive a consolidated PAT growth of 40% for the year FY24. With that said, I come to an end of my quarterly updates. Thank you for patient hearing, and we are now open to answer questions if any. Thank you.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question comes from the line of Pradyamna Chaudhary with JM Financial. Please go ahead.
Yeah, hi. So I've recently started tracking the business, so I have a couple of questions regarding the business. First, on the competition, could you help us with who are we competing with in terms of domestically and internationally, and what sort of entry barriers or switching costs we enjoy in this particular industry, especially considering the low content per vehicle that is currently there, and probably also because of lack of criticality of the product. Definitely, it's something which will grow very well, but it's not something which would stop a vehicle from functioning, right? So that's my first question. And secondly, could you also give an idea regarding the market share in India for us in in automotive sector, and whether we have more presence in premium segments, maybe in two-wheeler, like would you say that we have majorly present in 125cc segment? Any sort of data point on that? And IC versus EV also, if you can give. So these two are my questions. And thirdly, regarding your guidance for FY24, you've spoken about 50% growth. So is it right that the organic growth would be less than 10%, considering we are ending FY23 at roughly 300 crores and we are guiding for 450 crores for FY24, and 120 out of this is already from WPI acquisition. So yeah, these three are my questions.
Yeah, sorry, I think we lost connection in the midst of your question answer session. So I will answer what I heard. So first question you had was that who are the competitors that we have in India and overseas. So there is no company in India and overseas actually which competes with all the product portfolio we have. However, for specific segments, we do have competition. So for example, our chrome plating business, we have a company called Polyplastics, who is a competitor. For our decal business, we have a company called Plastic Stripes, which is a competitor. Our appliques, we have a very strong position in the market, so we are possibly the strongest there. There's only some French players who supply. For the overseas markets, we have companies like Megavigan in Europe, we have ADS in the US, and we have Serigraph in the US. So these are the competitors that we have. The advantage we have over these customers is that our business is batch mode. We handle a very large complexity, so we deliver our parts in close to about 6,500 SKUs to about 22 countries worldwide. And the printing process for itself is batch mode, so it's the manufacturing skill that is needed to produce these parts is very unique to this business, and that itself is a very high entry barrier. So our USP is that we have this manufacturing capability built over the past 30 years at SJS. In addition to this, we have low efficiency, and these are very critical factors to win in global markets. You made a point about the criticality of our parts, that they are simple. So I would argue against that. Our parts are extremely critical. So while these are not safety parts, but they are very critical to a customer from aesthetics perspective, and this is subjective. So customers over the years have built trust in SJS capability to deliver these high quality aesthetic parts, which are manufactured in the industry plant we have at India, which is among the finest in the world. So there are large entry barriers both in the process and in terms of our engagement with the customers for the past so many years. I'm sorry, I lost some part of your question because we disconnected. So if you can just repeat that last point for me, please. I'll address it.
Yeah, sure. So the second was regarding the market share that we have in two-wheeler industry and four-wheeler industry in India, and whether we are present across all the segments in two-wheelers, or is it more focused on premium segment, say 125cc plus, and whether we are present more in IC or in EVs. I know that it doesn't really matter, like our product is agnostic to both ICE and EV, but just to get an idea regarding the same. And third was regarding the guidance for FY24. I'm not sure if you had heard the question or not regarding the guidance-related question, where I was basically asking whether we are guiding for less than 10% organic growth, because WPI would itself add 120 CR to our base bottom line, right? So to our base number, revenue number. So those were the questions, and one counter question on the answer you just gave. So like I was just trying to understand, like technology-wise or even approval-wise, considering the cost is quite low of our product. So would OEMs be open to test with other suppliers as well? Is why I was trying to understand in terms of switching cost being low. So yeah.
So thank you for your very elaborate question. So I would suggest there's so many questions rolled into one. So for the benefit of other questioners, I would like to keep this brief. So you are encouraged to come to visit our plant to really understand the nuances of this business. But very quickly, because there are many complicated questions, many questions you had, not complicated at all, but to answer. So the one question you had was, what is going to happen, the outlook for FY24. So here, we have said our revenue will grow by 50%, our EBITDA will grow by 40%, and PAT also will grow by about 40%. The reason is that we are focusing on prioritizing growth over margins. So in the short run, we will be acquiring businesses which are long-term value creative for the company, but the profitability and growth will remain very strong. That is a track record that we've demonstrated as SJS and moving forward. In terms of organic growth, you said, are we going to grow at 10%? No. Organically, our business will grow at 20 to 25%. That business is growing extremely strongly.
Okay.
Which I don't recall now. The other point was that the customer testing for our parts is that, and you had a question on market share and customer approval of our parts, right? So our parts are small but very critical visually for selling the products of the OEMs. So customers pay a lot of emphasis, and they do not switch customers, suppliers very easily. So that's the reason why our relationship with our customers are more than 15, 20 years, and we are supplying to them across geographies across the world. So that is a very strong position, and customers don't like to upset supply chain that is delivering them the quality that they want.
Now we're just starting with manufacturing, so we're just wondering.
Sorry, please go on. Please go on.
Sorry, I didn't hear that. Please, could you repeat it?
No, nothing. There was some background noise. Nothing.
Yeah, okay. So maybe I think I've answered those questions. So maybe we can get some of the questions.
Hello.
Dear management members, the line of Pradyumna Chaudhary has dropped from the question queue. We move on to our next question. And before that, ladies and gentlemen, let me remind you to restrict to 2 questions per participant, as a fairness to others. We move on to our next question, which is from the line of Pritesh Chheda with Lucky Investment Managers. Please go ahead.
So there are 2 questions on acquisition and 2 questions on the recent performance. So first on the recent performance, if you could also, the way you gave the growth number for two-wheeler and tractor, it would be very helpful if you could give us what was the performance for consumer durable and exports YY in terms of Q4 and FY23. Then my second question on the existing performance is that your standalone margins have eroded a lot. That's the SJS margin. Can you tell us what is the reason and what is the floor or maximum extent of the erosion that is possible?
So, Mahendra, would you take this question?
So, if I understood your question perfectly, you are asking the export revenue. This current year, we had 319 million.
Sir, you can just give the growth or decline, whatever it is, for quarter 4 and fiscal year?
Yeah, quarter 4, we have declined by 23.8% on a YOY basis.
Okay.
And for the whole year, we are lower by 31.7% on the export side.
Same thing you can give for consumer durable?
Consumer durable, we are lower on quarter-wise 10.7%, and on YOY basis, we are down by 37%.
Okay. Okay. My other question was on margin.
So margin on SJS, our margin of EBITDA for the current quarter was 24.8%, and the last year same period was 25.3%. We have impacted by 0.5%, and that is mainly this product mix and the export sale impact.
My question is specifically on the standalone business. If you see, the margin erosion is quite significant. Okay. So if you could tell us the reason there.
You are asking SJS standalone quarter 4 versus quarter 4 on YOY basis.
So it's the lowest margin. Yeah, it is the lowest margin I think that I have seen on for the last 1, 2, 3, 4, 5, 6, 7 quarters now.
So that is on account of the lower two-wheeler sales, lower export sales, weighted high in the direct wages of approximately 2%, and lower than expected recovery in the two-wheeler segment led to higher labor hiring, which led to increase in the cost. So that are the major reasons. And this quarter 4, especially for the two-wheeler segment, and the special remain topic. And in this quarter, there is a regulatory headwind, which is the OBD2 implementation. And because of that, the two-wheeler manufacturers has reduced their production volumes. And as you are aware that SJS largely depend on the two-wheeler segment, and the two-wheeler segment has impacted, henceforth the margins have impacted.
So I didn't comprehend this answer because mix-wise, your two-wheeler mix has improved because you have grown faster than the durables or the exports. Then this margin explanation doesn't match with the mix explanation.
Maybe we are not listening to you very well. Please repeat your question again, please.
So we want specific answers to the standalone margins for SJS. We say this is the lowest. So let's talk with data.
So this is basically talking about the product mix change within the two-wheeler segment because of the regulatory headwinds. There were certain high-margin products within the two-wheeler segment. Almost margins are similar, but there are obviously certain products which are a little higher margin than the other products. So that has got impacted because of these regulatory headwinds, as well as our exports have also got impacted. So these two majorly has led to, the margin decline for us. But however, this is in the short run, because these are due to certain external factors which were beyond our control. And also in this quarter, we have taken up certain trials of certain new products, which has led to an increase in cost of our raw materials consumed also. And this is all in the short run that I could say that the margins have declined.
Just to supplement that, so we are looking at some strategic businesses. I talked of optical plastics, I talked of panel and illuminated parts. So all those products, we've been doing a lot of work at SJS. So while we have reckoned the costs, there are the no sales because this is all pre-okay activity that we have done. So under
Hello. Yeah, are we audible? Sir, now you have come back to audibility. We had lost you midway.
Yeah, sorry, we had a connectivity issue. Could not hear you so well. I don't know whether you got my answer.
Yeah, I could get your answer. I just follow it up with the other question. Is that when do you see the exports and the consumer durable business improving, or what is the floor of this business which has declined significantly?
No, so this is primarily because of the ongoing war, the rise in fuel prices and inflation in Europe and North America, which are large markets for us. At the moment, the answer is this is still a vacant. Time to recover would be 2 months, 4 months, we really do not know. But for the consumer businesses, so one big activity that's going to be added is with AlphaStreet India. We supply to a global company for their domestic volume, and we are in discussions to supply this for export markets as well. So the consumer business, what we guided to, that 20 to 25% share of our wallet will happen by 25-26. So we are very in line with that. Even the export story remains in that. It's only a question that the last 1 year has been tough because of this ongoing war and the challenges in Europe and North America as a region.
Okay. My 2 questions on Walter Pack. One, what is the market share that they have in the pack car business that they supply? And what is the net margins of this business? You have given us 30% EBITDA margin. It will be helpful if you could give the net margin. So market share and net margin, what it is.
So virtually they have 100% market share of what product they supply. They are in a near monopoly situation. They supply trims for some very leading OEMs. We have not closed the transaction as yet, so I cannot give you too much data around that. But trust me, we've done our diligence. They are in a pole position as far as market share goes, and their margins are exceedingly high. Now, one important factor to highlight here is that they do in-mold forming that requires films. So at SJS, we have great film printing capability. Walter Pack has great injection molding capability. So I am very optimistic that the margins at Walter Pack will grow. And clearly they are in line with the standalone SJS business. So they are close to about 30%, north of 30% in the margins that Walter Pack operates on. So I would also encourage you to look at this business holistically. You know, when a customer comes to me for a decorative product, so I have multiple technologies to offer them. Now there are some strategic decisions that we take in terms of business acquisition strategy to say what direction we want to nudge the customer to. So through our styling solutions, we choose to seamlessly move between SJS and Exotech and Walter Pack depending on what is the value proposition for a certain model. So that gives me that leeway to negotiate and offer new technologies. So many times customers migrate from SJS to Exotech or Exotech to.
Okay, sir. Thank you.
In the long run, I would like the community to think of it as one business.
Okay, sir.
Our next question comes from the line of Rakesh Jain with Axis Capital Limited. Please go ahead.
Yeah, hi, Sanjay. Thank you for taking my question. Just one question on the standalone business. If you look at the top line, quarter on quarter, 2 quarters, you see a decline. So is there any element of commodity pass-through deflation in commodity prices, which is, you have to pass through, and that's like adjusting for that, you are seeing this topic? Any under recovery or price hikes which is impending, which is impacting your margins over here?
So not really. So what I said was that Q4 was an unusual quarter because many of the customers had to shut down models to make them BOD compliant. And as Devanshi mentioned earlier, there were some high value parts, so certain models were impacted. So it's a skewed bag. So the right way to year-on-year basis. So if you look at year-on-year standalone SJS business, so we have grown margins, we have grown revenues, despite a big impact on exports, because exports was a large chunk of SJS standalone revenues. So that being impacted, there has been a consequential impact. But we have more than made good this loss by improving efficiencies, by improving margins, and also driving growth in other businesses, especially Exotech. So for the full year, our margins have grown by about, PAT has grown by about 13.4%, and our EBITDA has grown by about 12.2% at standalone areas.
Got it. So, how would you look at it, this decline in two-wheeler sales? I mean, is it picking up? When are you seeing it come back to recovery? And also,
It's already come back.
What is the situation?
It's already come back. So it was, sorry to interrupt, so it has already come back. It was an event based on 1st of April. There was a regulation that vehicles which were not OBD2 compliant, that means that they did not have an issue which you could put a diagnostic probe and check the vehicle emission levels in real time. That was a mandate by the government, and these OEMs had to change their model mix, so they cut down because they could not sell vehicles without this after 1st of April. So now that has passed us. So already the industry is back. So we have very strong revenues in April, May. So we see that business will grow. Also, there was an impact that some newer models the customers wanted to refresh because there's a cost impact on this OBD2 implementation. So many customers are launching these new models. Some of them have got launched in the last month, and some will continue in the next month or 2 months. So we will come back to normal very, very quickly.
That was helpful. Suffice to say, sir, next quarter onwards, your mix will again come back to normalcy and probably margins will look upwards from this quarter.
Absolutely.
Great. That was helpful, sir. Thank you.
Thank you. Ladies and gentlemen, a reminder, please restrict to 2 questions per participant. Our next question comes from Anshul Mittal with Care Portfolio Managers Private Limited. Please go ahead.
Hello. Yes, sir. My question is with regard to Mr. Joseph. So I wanted to understand the reason for the equity dilution of 30 crores, considering that we have strong cash flow generation and also a strong ROC profile. So what was the reason for the 30 crore dilution of equity?
Sorry, your question was not very clear. Could you repeat once again?
So, sir, I wanted to understand the reason behind the fundraise mix on the equity dilution of rupees 30 crores, considering we have a strong ROC profile and cash generation. So, what was the reason behind it?
The reason is simple. Joe is a promoter of the company. He believes strongly in the business, so he wanted to increase his stake. So that is the reason of this preferential allotment, and that was also so one reason was that he believes in the company and he would like to have a greater stake. The second, of course, is that he helped us with our cash outflows for the water pack acquisition. So these are the 2 main reasons why Joe increased his stake.
Okay. And sir, considering the growth guidance which we have given of 50%, so I just wanted to understand the fair breakup between organic, inorganic also divided between Exotech, Volterpack, and considering we are not able to witness a stable growth we are not able to witness growth in standalone performance of the company since, I don't know, 6-7 quarters.
Your voice is not very clear.
Hello. Am I audible now?
Yes, you are.
Yeah. So I wanted to So I wanted to understand the breakup between the growth guidance which you have given of 50% between Volterpack, Exotech, and the standalone business. Also, do we have, considering if the macroeconomic environment stays this way for some more time, is there any chance for further revision, downward revision of this growth guidance which we have provided?
No, so the guidance that we have provided is obviously based on considering the current environment, but definitely in case if the situation gets worse, then probably there could be certain interruptions in between. But however, we feel that the guidance that is given of 50% plus kind of revenue growth is on a consolidated basis, including SJS, Exotech and Voltapack. And organic means SJS and Exotech together now is one company. So that we are saying will be growing at around 20 to 25% for the next year.
Okay. So currently coming into the season, have we started already looking, the two-wheeler industry has already started looking to improve the situation currently for this couple of months? And
yes.
Hello.
Yes. So as I answered the previous question, so Q4 was impacted in the two-wheeler because of this one-off OBD2 norms implemented by the government. So this has already recovered. So two-wheeler is now back. So we don't expect any. So that big challenge of Q4 is faster now. So we are quite optimistic that this growth will continue, and that is what is factored in our projections.
Okay. And so that was the last question from my end. Can you please provide the...
Sorry to interrupt you there. Could you please join back with you for further questions?
Just last question from my end. Yeah. So I just wanted to understand what is the capacity utilization between Exotech standalone and WPI currently?
So Exotech, as I said, we already doubled revenue since we acquired it. So it is running close to about 80% capacity or 90% capacity utilization at the moment. There is some capacity available in the paint shop there, which we will use to drive growth, but that's a matter of detail. At Voltapack, the current utilization level is close to about 60%. And
SJS is also 60 to 65% utilization.
Okay. Understood. Thank you.
Ladies and gentlemen, a reminder, please restrict to 2 questions per participant. Our next question comes from the line of Harshal Setia with All Fund Advisors. Go ahead.
Hello.
Harshal, your line is
Hello.
you could please proceed with your question.
Hi, sir. Sir, how do you define mega accounts in our presentation?
sorry, your voice is not clear. You have to repeat your question, please.
How do we define or what size is defined as a mega account in the presentation?
So we say we are creating mega accounts where we grow businesses by close to about 2x to 3x over the last 3 years. So that is the pace of growth of business vis-a-vis the potential of the customer. So that of course depends from customer to customer. It's a very wide universe. But there are few strategic customers that we focus on, which give us sales opportunities both in India and overseas markets. So these are strategic customers for us, and we follow these accounts very, very carefully. And I'm happy to say that we are getting very good response for all these strategic customers that we have.
Okay, thank you.
Thank you. Our next question comes from the line of Lokesh Manik from Valum Capital. Please go ahead.
Yes, good afternoon to the team, SJS team. 2 questions from my end. Both are on actually cost expenses. One is pre-2020, we were incurring cost expenses in the form of site labor supervision cost contracts, and secondly, packing expenses. These expenses have ceased to exist post-2020. So if you can just provide some explanation on the nature of these expenses, whether they are fixed or variable, have they been reclassified into subcontracting charges post-2020?
So, Lokesh, if I understood, your question was one of the selling side commission amount. So earlier we had a outsourced commission business where we are paying the commissions.
Right.
Later on we had our own sales team and we brought this in-house, and for this expenditure has gone out. I missed out your second point. It was subcontracting or something else you asked?
Yeah. So this was, so actually that was my second question, which you just answered. My first question was there was a expense item on site labor supervision cost contracts.
Site supervision cost. So earlier we have a model that we have multiple warehouses and we are packaging for the customer at the warehouses. Now
Hello.
The VAV has a long back and henceforth you will not see this expenses separately.
So just for clarification, sir, so you had earlier a lot of warehouses and now you've consolidated that so those expenses have ceased to exist. Is that understanding correct?
We do have warehouse as of now also, but the working at warehouses has limited and the packaging has been done in the factory now.
So there was repackaging done to warehouses, and there were supervisors required for that repackaging depending on the customer demand every day. So there's a full network that we have. So now these are packed and snatched from the factory itself, so that cost has gone away.
Okay, and we've seen subcontracting charges post 2020. So what are these? Would this be the same thing or would it be different?
Subcontracting charges is the contractual worker who are working in the factory, that is the cost.
Okay. Understood. Thank you so much for the clarification. That's it from my end.
You're welcome.
Thank you. Our next question comes from the line of Harsh Mulchandani with Press PM. Please go ahead.
Thank you for the opportunity. Just wanted to ask a couple of questions. One, what is the percentage export for Volta Pack which we've acquired? And in terms of export, are we seeing any sentiment improving? Like you said, it will take maybe 2 months, 4 months to recover, or maybe longer. Just wanted to ask. This is my first question and I'll come to the second one.
Okay, so on Volta Pack at the moment does not export. There's a very small business that they export. It's about 3%, so a very small percentage of their current sales. When we look at what sell those products to our significant export customers across 22 countries. The other question that you had was on
the sentiment if
Europe export market recover. So that is a question to be put to Mr. Putin and NATO, I believe. But anyway, let me answer it to the best of my ability. So we see demand coming back. The shock that was there earlier because of the war has gone away. People have not absorbed it. So sales are being relocated out of plants in Russia to some other countries. Some people have found an innovative solution that they do supplies through a country like Turkey. So supply chains are realigning. So recovery is happening, but it is gradual. So that is the best answer that I have for you at the moment. And we factored this in our sales forecast. So we don't expect dramatic turnaround to happen in exports, and that is what is built in our sales forecast as well.
Okay, fair. And second question was, after this acquisition, so is it safe to assume that for next 1.5 years you'll be working on the integration, and that's how the plan of action is to work for next couple of years?
No. So we are very little on it. So our integration does not take that much time. As you said, I explained to you from data on Exotech. So we doubled the sales in the 2 years. We expanded the EBITDA margin by 300 basis points. And integration happened possibly in the first 6 or 7 months of our acquisition of that company. So Volta Pack is a mature company. We have a management team. The reason of getting Roy, who's been with this company since inception, as a part of this team is that there is zero loss of transmission, and we run the company and hit the ground running at Volta Pack. So our plans for Volta Pack are extremely bullish. And as soon as we complete this acquisition, we will run very fast. So I don't think there will be any time barring maybe a month or two for integration. We will be able to run that business very, very quickly, very, very fast.
Okay, got it. And Volta Pack is also grow at 20-25% in the coming years, right? Is that understanding then correct? Because then your guidance of 50% looks on the conservative basis.
Yes, it will go at 20-25%. That is the outlook for water pack.
Okay. So then your 50% guidance looks to be a conservative number. Is it to because 30-35% growth will come from the consolidation of numbers itself. So just to
Question is not yet closed, so we still need to relook at the numbers and work out our guidance for water pack. The only thing we can say right now is that yes, we definitely expect water pack growth to be a lot higher than consolidated. When you combine SJS and Exotech, and SJS and Exotech together, the organic growth will be around 20-25% for next year.
Got it. Okay, fine. That's it. Thank you.
Thank you. Our next question comes from the line of Jyoti Singh with Aryan Capital Markets Limited. Please go ahead.
Yeah, thank you for the opportunity. And yes, SJS team will explain about the latest acquisition, and that is a Volta Pack. But I just wanted to one clarity on the new segment that we have entered after the Volta Pack acquisition, as we already there in the IMD, IML, and IME.
And maybe you have to repeat the question a little slowly.
Yes. Yes. So as you guys well explain about the Volta Pack acquisition, but I just wanted to have one clarity on the new segment that we have entered after the acquisition of Volta Pack.
Okay. So fundamentally, what Volta Pack specializes is in mold forming. Now, what happens in this is that you have a very deep formed surface of the film, which is thermoformed, and then that is used as an insert in the injection molding machine. And the technology involved here is that you also need to trim it in a three-dimensional space. So whatever IML SJS was doing, this supplements that capability. So SJS IML parts were smaller parts, smaller in size, and also the forming depth was very small, only some radiuses of that point. So there was, so this is the point that the difference between what we have acquired in terms of technology and Volta Pack. So in mold forming is what goes. So Joe, you have got something?
Yeah, apart from the conventional one, then we also have, the electrical segment that we are entering, which is, for the switchboards, etc., which is a very large segment.
Okay, thank you, sir. And sir, second, if I missed the market share commentary, as per the segment-wise that we have in domestic as well as in exports, like two-wheeler passenger vehicle segment and consumer durables. Hello?
Ladies and gentlemen, this is the operator. We have lost the line of the management. Please stay connected. Ladies and gentlemen, we have the management line back. Ms. Singh, you could go ahead and ask your question.
Yes. So, sir, my second question on the market share commentary, if I missed. So, if you can explain as per the segment-wise in domestic as well as export trend.
Yeah. So, in domestic market, I would say that there has been a significant contribution from the domestic market. For the full year, we have grown by 24%, and for the quarter, we have grown by around 5 to 6%. The major contribution has come from passenger vehicle and farm equipment for us, while two-wheeler segment and consumer goods have seen a little decline of about 4% and 1% for the quarter. Whereas if you see for the full year, two-wheeler segment for domestic market has grown by around 27% for us. Passenger vehicle has grown by around 33%. Consumer goods has also grown for us by about 5%, and balance is other segments which has grown for us by about 8 to 9%. So overall, domestic market has grown by around 24% for us for the full year.
Okay, thank you. And third question on the outlook front, if you can explain me like what are expectations for H1 FY24 and another is H2 FY24.
Overall outlook we have given for the entire year, and we would like to stick to that on a consolidated basis, we would be growing by around 50% on our revenue, and EBITDA would be growing a little soft at about 40% growth that we can see for an overall consolidated business.
Okay. And as we have acquired new client in this quarter, so are we any discussion with more clients? And also, we will be supplying all Mahindra EV in passenger vehicle segment?
So we are in
so acquiring clients is an ongoing process at SJS. So we continuously work on mining clients and increasing share of business with existing clients. So we are in talk with many people all the time. And as this quarter we said, we've added LiftMed as a medical devices customer. We've entered into the Samsung EV segment. Plus we won new business with many of our customers. So all of this is an ongoing activity quarter to quarter, and that's what leads to outperformance by SJS vis-a-vis the industry.
Okay. And sir, are we going to supply all Mahindra EV in passenger vehicle, or we are selected for certain products?
I can't answer. We don't have a policy guide on specific customer, specific models, but needless to say, we are a very important supplier to Mahindra.
Okay. Thanks a lot. Thank you.
Thank you.
Thank you. Our next question comes from the line of Viraj with SIMPL. Please go ahead.
Yeah, hi. Thanks for the opportunity. Just a couple of questions. First is on Voltas India. If I look at the history, and when I talk about history, it's like last 8-10 years financial history, say from 2014 to 2022. The average margins at the EBITDA level has been around 16%. Rarely they have even crossed 20% EBITDA margin. So when we say the entity has done say 30% EBITDA margin in 2023, what has driven that, and why we think it's a sustainable margin for that company?
Two major changes that have happened in Voltas is really that they've won a lot of businesses for some new models with new technologies, and they are one of its kind. So they work very closely with tier 1 suppliers, making the interiors of the car, and there are some exciting new projects which are already awarded and in advanced stages of productionizing. So we see very strong visibility. So last year, their margins were very good, primarily because, so two things in terms of margins. So they used to pay royalty to Voltas Spain, which will go away, and that is coming down quite significantly. So that aids margin growth, and the revenue increase is quite dramatic, which is for both customers, both the passenger vehicle OEMs as well as for the consumer electrical business that I said. So there are some new products that are starting, which are leading to growth. So last year was a very strong year for growth for Voltapack, and the next 3 years also look very promising.
What is the royalty they used to pay earlier? And with this, now we have a service and technical fee arrangement. So what is the payment we would have to pay to Voltapack Spain?
Yeah. So they were earlier had 6% royalty payment on the sale, which has now declined to 3.5%. And after we took over, we will have a payment of absolute amount which will be more than 3.5%. We have agreed for a 3-year technical support agreement with the company. Hello?
Dear management members, the line of Viraj has left the question queue.
Okay.
Ladies and gentlemen, since that was the last question for the day, I would now like to hand the conference over to the management for closing comments.
Thank you everyone for joining us on this call. And if any participants are in the queue and I can see that, you can take the questions offline or you can email it to me. Due to time constraints, we will have to close this call. Thank you.
Thank you. On behalf of Axis Capital Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.